And that's it for today. You can hear it. That was the closing bell from the New York Stock Exchange. It was another up and down day for the Dow Jones. The Industrial Average closed the day up around 270 points or so. This was the third straight day of gains after a mostly rough January.
The Nasdaq and S&P 500 also ended the day with gains. For more on the day on Wall Street, let's bring in Mike Lewis. He's the head of the U.S. equity cash trading at Barclays. January, as you know, Mike, was a little bit of a rough month for the stock market, and the start of February isn't going much better. What are the driving factors behind this sort of lackluster performance today?
Yeah, hey guys, thanks for having me on. In a nutshell, it's just equity markets catching up to what bond markets and credit markets were kind of warning about last year. From September through December of last year, bond markets crept a little bit wider, investment grade, credit markets went a little bit wider, bond markets fell, yields rose, and during that time, the Nasdaq and the S&P both went up as well. So people were waiting to see which one was going to revert to the other, and when the Fed dropped transitory from its language, it became apparent that equities are going to have to fall a little bit. So, you know, we've seen that, and we've seen some really, really big moves and some underlying factors. So, you know, that really has been the driver with the increased expectations for rate hikes from the Fed, and equity markets having to kind of revert back to what bond markets and credit markets were implying towards the tail end of last year.
And so, Mike, for the market to rebound in February, what do you think needs to happen?
Yeah, I mean, I'm not so sure it's going to happen. So, you know, what would need to happen? I think the Fed would have to walk back what they've been saying, and I don't think that that's a high likelihood. I think that, you know, what we've been talking about here with our clients is that we've been expecting a bounce, and we have gotten a nice bounce for the past 2 or 3 days. My guess is we're going to continue to see that through the course of this week because we've been washed out. There's been really, really significant selling across most market participants and across most market products and most factors. And tonight and the next couple of days, we have big tech reporting earnings. And given how much selling we've seen, my guess is that will be met with some positivity, even if the numbers aren't as great as people were expecting. And we probably rally through Friday. My recommendation would be to sell into that rally because the narrative with the Fed has changed. And until we see, you know, what happens when they do start to hike and when they go from a quantitative easing process to a quantitative tightening process, you know, I think people are going to be a little bit worried about equity risk, and they'll probably be selling rallies.
But so, Mike, there's always people looking to buy, right? So, you know, if they've got to put their money somewhere right now, where would you advise them to put it?
So I can't talk about single names. But what I would say is make sure that you're being tactical with what you're buying and look at stocks and potentially factors that you really like. I think growth is going to be challenged in the near term, especially super high multiple growth stocks. So I probably wouldn't look there. I would be looking at portions of the value and cyclical chain, and you know, maybe semiconductors fit a nice bill of both, where they're a little bit cyclical and a little bit growth together. But I can't really mention single stocks. For me, like, I'd be looking to think names that you have conviction in. Wait until it gets to a level that you're comfortable with, and maybe pick away there. But I do think that you're meant to be selling rallies in the market as opposed to be looking to buy dips. I think that's the change in narrative. The last 12 or 13 years from the great financial crisis has been about buying the dip.
Yeah.
I think this year, until you learn a little bit more, it's going to be about selling the rallies.
That's interesting. You know, usually they say when it goes down, buy, but he's saying, wait, just wait.
Just wait. And Mike, you know, the hard part is the names I'm familiar with, they're really pricey.
Yeah, they are. Yeah. And what I would say is the last thing, and I don't know if we're running up against time or not, but you know, whereas the past 3 or 4 or even 5 years has been when growth really outperforms and money comes out, every dollar that came out would go into value and cyclicals. When they got overbought, the dollar that would come out would go back into growth. I think what might happen now is when money starts to come out of growth, part of that dollar goes back into different factors, and maybe some goes into the bond market, maybe some goes into credit, maybe some goes overseas. It's going to be challenging. So we have to see what the Fed's going to, we know what the Fed is going to do. We have to see what the impact of what they're going to do is upon inflation expectations, and then we can see what the second half shapes up to be.
Some diversification there, it sounds like. All right, well, Mike Lewis, thank you so much for joining us. We appreciate your financial insight.
Yeah, thank you guys for having me on.